We start today's market talk. The best lack all conviction, while the worst are full of passionate intensity. Why I wanted to say this is there would always be uncertainty in the market. There would be always be things which you can't foresee, which will impact the stock prices and all that. So stay cautious. Don't be totally convinced because that will take you down. Like recently, what has happened? Fed has acted, forecasts have shifted, that there will be a lot of rate cuts. Markets played along. All the world markets, US markets are at all-time high, but there is no movement. I'll show you in dollar index, US 10-year yield. Nothing has happened. They have actually gone up while dot plot in the US is showing wide dispersion. So there is a lot of talk about rate cuts, etc. Hence, there is lot of uncertainty about path of future actions, what all people are going to do. So don't be too sure about anything. Take cautious, and the best way to be cautious is to buy at lower prices. Buy when there is nobody is looking at a stock, when the stock is in total disarray, not when everybody is passionate about the stock and everybody is euphoric. So you will buy the stock at the peak. Okay, market outlook. Four events this week. First, we recent one. So on Friday, September 19th, Trump signed a proclamation that will raise the fees for H-1B visas to $1 lakh annually. So, as everybody is aware now, 71% of H-1B approvals in FY24 were for Indians. New fees will deter on-site deployments, reduce overseas hiring, affecting remittances back home, housing decisions among technical or technological professionals. 40, like if you heard the Hexaware guys, their CFO was there. He was saying that 40% of their employee base in the US is H1B based. So there would be a significant cost increase. Margins will get impacted. Companies will impose travel restrictions similar to the way they had done in COVID. Deals will slow down. Fresh deals will take a lot of time because they are not sure about the cost. Will lead to offshoring. Prices will increase. So the margins, either they will have to take some cuts, or the margins of the Indian IT companies will get affected. And already Indian IT companies were struggling for growth. So it's a very unpredictable environment. Now, the other issue was FOMC, Federal Open Market Committee, decided to cut the target Fed funds rate by 25 basis point. So this is the first reduction since December 24, indicated plans for two additional cuts by end of 2025. US stocks made fresh all-time highs. And the best part for the US is that, or the Trump administration is that Powell will retire next year, replaced by some Trump nominee who will do his best to push interest rates down before midterm elections. A dovish Fed also makes it easier for RBI to cut rates with inflation remaining benign. Now, GST relief and food deflation augur well for further easing of rate cuts in India in October because CPI has come down or will come down by 80 to 100 basis point with cars, autos, consumer discretionary staples, everything, where all these companies which are doing all this stuff are passing through the tax savings. So there would be a uh, decline in inflation. Hence, RBI can easily cut rates to slightly give a push to the economy. Now, the other significant issue is which nobody is talking about, but I'll show you in the charts that the defense stocks are doing well is because government has launched a 15-year roadmap to modernize the armed forces. This is covering 200 plus weapons and technologies. For defense companies, it opens up multi-decadal opportunity to integrate production, supply chains, and advanced technological platforms. The most ambitious roadmap is for Navy, including a third aircraft carrier. So the point is, don't look at defense stocks at 1 or 2 quarters horizon. Look at it slightly long term. Or if you have to see earnings, look for the full year's earnings and over a period of 2 3 years earnings growth, etc. Okay, FIDI data. So if you see here, FI's shorts had reduced to 1.47 lakh short positions, but they on Friday they have added index shorts both in Nifty and Nifty Bank. They have bought calls and they have bought puts, but puts are 2.68 lakh. So their bias is still negative. Now, what are the pros doing? Pros have started adding short positions. They were turning bullish, so now they have started turning bearish. They have bought calls, but they have bought puts also. While on this all Friday, if you see, they have sold a lot of calls. So that means what? So though they are still net long, but they are turning in between. Clients clients are long on index futures. They have sold calls and they have bought puts. They have sold puts also. So net, if you take out selling of calls, is that they are net long on, that is they have sold put, so they are net long. So the point is that the extreme positions which were there of FIs and clients are changing, but this is natural before expiry coming on. So what is happening is that FIs are covering shorts, DIs are or clients are covering longs, so reducing those long positions. So it is again a equilibrium is being maintained, and pros are shifting from last week they were long, now they are shifting slightly to the bearish side. So just keep that in mind. So if you see the FI data for the month as such, from a peak short positions in index futures of 1.91 lakh, it has been reduced to 1.44 lakh. That was the lowest, and that is when the index also made a high. From that 24,500, 700 levels, it has gone up to regularly it has gone up because every day they were slowly and slowly reducing their short position. So the change, if you see, they were slowly from 1.91, they have slowly reduced the short positions, and index has also moved up simultaneously. Now what happens from here, one has to see. Now coming to the US, their markets continued a 3-week winning streak after Fed delivered a long-awaited interest rate cut. And in addition, Trump held a phone call with Xi, calling it very productive and agreeing to visit Xi in China next year. So, if you see here, after the rate cut, the US yield had declined to 4%, but then bounced back because people are unsure about the future future direction of rate cuts as to whether it will be delivered or not delivered, etc. A lot of uncertainties there. Similarly, for dollar index, it had declined and then has come back to the similar level. So it has come back to that 97.66 level. So again, there is uncertainty related to it. So if you see after the rate cuts and talking about future two rate cuts this year, still the bond yields have come back and the dollar has strengthened. Now Brent crude declined, so it is firmly below that 66 or 67 level. So I don't think it is going to go up. Gold has continued its further higher gradient because of uncertainty and all. Corrected a bit, but still it is higher. So because of this uncertainty, and now there is no clarity, so we'll have to see it first what direction it goes. Silver has broken out, continues to go up because it's in addition, it is cheaper as compared to that gold silver ratio wise. If you see, silver is cheaper, plus it's an industrial commodity, hence it is now moving up. Copper, nothing much at the similar level. It started moving up because there was supposed to be a decline in dollar, but that has got arrested. Hence, the copper prices have come down. Bitcoin, nothing much. It went up after the rate cuts, but has declined after there is uncertainty. S&P 500 made a fresh high, 1.22%. Nasdaq was up 2.22%, so again fresh high. And Dow Jones also made fresh high. And on Friday, I think the FedEx reported strong growth in terms of revenue and profitability. So all the US markets are high. Basically, all the money which is being pumped into AI is taking them higher. Now coming to India, India VIX is below 9 now, so below 10, sorry. So that is totally complacency, because that means everybody is on the same side of trade. So this is actually not good. There has to be some amount of trades on both sides, because then you get taken. A market takes you out if you trade only in one direction. Now Nifty, if you see on the weekly chart, the declining trend line from the previous highs is somewhere closer to 25,500. So it has to take out that level. It tried to go there and reverse from there. So it needs to take it out to move higher. The support would be somewhere after 3 weeks of highs, somewhere closer to 24,700 odd levels, which is a 20 EMA on the weekly chart. Though the benchmark indices have been gradually moving higher, uh, on Friday we saw some profit booking. Let's see it on the daily chart. So if you see, it went up regularly for 4 days of the uh, last week, and then on Friday we saw profit booking. So it reduced some of the gains. Now, if you see here, from the lows of 24,400, we have had a straight rise for 15 sessions, uh, and 1,000 odd points we have gained. With broader participation, I'll show you on mid caps and small caps also. So for Nifty, the immediate support is this breakout level, which is 25,150 to 25,250. This should be the immediate support. So if it takes support here after the whatever happens tomorrow, then it will be good. Otherwise, if it breaks this, then it should test this 25,000 levels. On higher levels, if you see here, if it breaks through this level, uh, then it is first headed towards 25 600 700 zone easily, and then 26,000. So we'll have to see how the thing plays out. But this support of 25 150 25 250 is very critical. So if it is taken out, then you're heading to 25,000 and 25 800 odd levels. So let's see. If you see, India's macros are resilient and CPI and is moderated, that is inflation. GDP growth is decent. So what is happening, if you have seen, FIs are gradually covering their shorts. And there, because of there was some optimism around Indo-US trade talks also. So right now, let's see how it progresses. Now, hourly charts. So if you see here, there is a gap here, so which I told you, which should be the support. So it had broken out through this gap. So first support is this 200, 250 and 280 zone, and the second support is lower at 24,880 to 24,900 level. So these are the two gaps which should provide support. So if this breaks, then the next support should be, I think, 25,000, and then this 25,800, 880, 900 odd levels. Nifty Bank, similarly, three consecutive weekly gains. So it had gained around 1.19%, more than Nifty. Move of around 2,000 plus points in 11 trading sessions. I'll show you. So if you see, it started moving from here only. So 11 trading sessions, it has moved 2,000 plus points. And it is well above the 20 and 50 EMA. Holding above 20 EMA, that is around at, this is a 20 EMA at 54,900 odd, would be crucial for maintaining bullish bias. And the first resistance should be around this 56,000 level, the previous level from which it had retraced. So that should be the first resistance, or that should be the first target, and then beyond that to 57 250. So first, let's see if we can take out this 56,000 level. What has happened with if you see options data, long short ratio has improved to 13%. That is 13% long from 8%, which was earlier. Though the other point is that, as I showed you, the US dollar is strengthening, so that is keeping FIs cautious. And the market sentiment improved, with sentiment improving on Adani Group stocks on Friday. So that was positive. So HDFC Bank had a big decline. Actually, it was sold off, and that is reflection of the FI selling actually. So it sold off in a big way on Friday. So it gave up all the gains it had made for the week, and again it has come back to that crucial level. But the support should be around this 940, 950 level. So let's see where it goes from here. Reliance again, it went up above this 20 and 50 EMA. So let's see if 1400 level is retained. If it breaks, then I think we should take support at lower level. And the last support was at around 1340. So 200 EMA should be seen. Infosys, I was mentioning. So if you see here, Infosys, this 1400 to 1430.25 is the demand zone. So generally, if you see from April onwards this year, whenever it has come to this level, the buying has come. So let's see what happens, and whether it is able to hold this zone. But that should be a good level to accumulate emphasis. Now, coming to sectoral performance, FMCG has given up most the momentum now. So it went up after the GST cuts, but now it has given up, and it was negative last week. Now, Nifty IT was up, but it has not been able to take out the declining trend line. So it should take out this declining trend line for some strength. Otherwise, it will again test the 200 EMA. Consumer durables, again, it has lost momentum. So it made a kind of a inverted hammer. So that shows there is likely to be some change of trend. So there is no momentum now left in consumer durables. It has had his movement, and now it is coming down. So durables are basically the discretionary items people buy, electronic items and other issues, clothes and all. The index which is breaking out is Nifty Metals. It has clearly broken up last 2 weeks based on dollar weakness. So we'll have to see now how it goes, because dollar has started strengthening. So if the dollar keeps strengthening, then it will come down. The other index which is breaking out or doing very well is Nifty Auto. So if you see, it is nearing its previous all-time high, which it made last year. So the auto stocks, the pack of Maruti, Mahindra, uh, Eicher, Hero, Bajaj, TVS, etc., they are doing well, and this is where the momentum is. Now, defense stocks, if you see last week, were up 3.41%, and last 3 weeks, defense stocks have been moving up. So this is one sector where there is a quite momentum because of this 15-year plan which government has come out with. So that gives a long-term visibility for procurement actions and companies to also develop capabilities. So remain positive on defense sector. Now mid-caps were positive, so which was good, went up 1.2%. So let's see if it can take out its previous high, which is not very far, actually 200, 300 points. And small caps were up 2.86%. So the portfolios would have done well. Now I'll cover two stocks. First is Centum Electronics. It's a leading provider of end-to-end electronic system design and manufacturing solutions. It is established presence across high growth sectors: defense, aerospace, space, EMS, and ER&D. So there are a lot of experience in this thing. And if you see their consolidated revenue, the 56% of the revenue is coming from defense, space, and aerospace, then from transportation and automotive, then industry and energy, and then healthcare. And the major revenue is coming from EMS, and then engineering, R&D services, and build to specification. So build to specification is basically for defense, and for other sectors they are EMS and ER&D. Revenue graph, if you see, 59% is from Europe and UK, and 31% is in India, which is increasing, and North America and rest of the world is 10%. So it is not that US dependent. It has got global operations. So actually, that is the problem. I'll show you why global operations are a problem. Now, leading provider of end-to-end electronic system design and manufacturing solutions with a presence in defense, aerospace, space, transportation, industrial, and healthcare sector. Our portfolio includes build to specification solutions, electronic manufacturing services, and engineering R&D. Domestic customer base includes HAL, BEL, BDL, ISRO, DRDO, etc., and ordnance factories. On the industrial side, it supplies to Siemens, BHEL, ABB, Hitachi, Baker Hughes, among others. Internationally, its relations extends to companies such as Thales, Airbus, Rafale, and Alstom. Its standalone business represents its India operations, which are largely driven by BTS, that is built to specifications, and EMS segments for defense, space, and aerospace customers. It supplies electronics for radars, missile guidance and control, UAV payloads, torpedo fin controllers, and tank electronics. It is present on major Indian missile programs, and it is also the largest avionics partner for L&T in strategic programs. It has also indigenized 12 LRUs. LRU is line replaceable unit, a modular component and scale units which can be replaced in a short time for tanks, covering optical sensors and alarm signaling units which are being integrated into T-72 and T-90 platforms as part of their next phase of indigenization. It has received rupees 300 crore of orders for payloads in 3 satellite constellations. For FY25, major order wins include new satellite payload programs, radar subsystems, and additional indigenization contracts for defense electronics. It does around 1100 crores of revenue. So presently the order book is around 1770 crore. Expanding domestic defense opportunities and emerging international markets, it seems well positioned. Divestment of its Canadian subsidiary would further streamline profitability. This is very important because their international operations are the ones which are loss making, and that is why the profits are coming down. So now if you see here, considering the three verticals, they did around, this is millions, so 1155 crores of revenue in FY25. Major was EMS, then BTS, and ER&D. Now the difference is in ER&D and EMS, the margins are low, but the cash flow is quicker. In BTS, the which is basically for defense, aerospace, satellite, etc., the margins are higher, but the time period required for the project completion is also more. So decent mix. In Q1 FY26, they did around 273 odd crores. So order book, if you see here, is divided adequately and more towards the build to specification, which is 50%. So that is basically defense, and then EMS and ER&D. So they are shifting now more focus towards defense part. Now, in build to specifications for space, they are doing various things: electronic warfare, satellite subsystems, small satellite and payload integration. For defense, they are doing missile control and guidance. This is they're doing with BDL, radar subsystems, tank electronics, etc. Then for railways, they are doing public address, intercom, passenger information systems, etc. Now in electronic manufacturing, industrial and medical, so they have various things they are doing. For electric mobility, they are doing this battery management system for electric three-wheeler, MK2 encoder, electrical commercial vehicles, inverters, etc. for electric buses. And defense and aerospace, again in this, they are doing air traffic management, sonar subsystems, etc. Then in ER&D, engineering research and development, they have wide circle, and they are doing a lot of job in terms of embedded software, efficient electronic hardware. So they have a lot of designing and global delivery centers in this kind of job. Now there is a wide diversion or difference in their earnings. So if you see, these are standalone income statements. Standalone part is the Indian part of the business. So here, if you see here, They are profitable, and EPS is around 40, was around 40 in FY25, and this year should be around at least 50, because the last quarter is good and margins are good, and revenue is around 750 crore, and this year they should do around, I think, around 1000 crore in domestic business. The problem comes when it's a consolidated thing. So the consolidated revenue goes up, but growth tapers down. It is not growing because of the international operations. And if you see here, the the operating revenue is growing decently, right? So gross profit also is static, and net profit is actually 129. They were suffering a lot of losses, if you see earlier, and adjusted is 129, and EPS is just around, for FY25 it comes down to around 8, while domestic business it was around 40. So that is the problem, and that's why they want to divest their Canadian business. EBITDA margins also declined because of that. Hence the PE seems to be very high. So now coming to the chart, so if you see, this stock has been moving up regularly, and on Friday it went up 6.98% above the 20 EMA. So it has broken through that, went up to 2800. So it's a very difficult stock to really see and understand. Hence, the best option is to buy it at good levels around 2500, 2600 once it comes there for long term, and not for short term, because right now it is in momentum, because there was a momentum with respect to Rafale and defense and other issues. The other stock is Adani Power. Now this is again interesting stock. Took me a lot of effort to understand what they are doing and how they are doing their business. It's India's largest thermal power producer in the private sector. Overall, it is NTPC. So in private, they are the largest thermal power producer. Over the years, it has expanded its portfolio, which currently comprises 12 assets and addresses the power requirements across 8 states. Incrementally timely project completions. What is the problem with power project? One is land, then equipment, that is boiler, turbine, generator orders, and then construction execution in timely, which is a good part with Adani Group, and lower external debt combined with PPAs, power purchase agreements getting signed, would drive earnings. Now, what happens if you sign a power purchase agreement while the project is being executed is that the you get loans at the lower rates from the institutions. Currently, its operational capacity is 18.2 gigawatt, out of which PPAs are 13.6 and merchant is 3.9. So the revenue visibility of PPA is much better. Among the under construction portfolio is 23.7 gigawatt. PPA is just 8.5, which is 36% of portfolio, and merchant is 15.2. So which they are trying to do the PPAs. Under construction portfolio stands, as I told you, 23.7 gigawatt with 92% of the land secured. 60% of the capacity is brownfield expansion. That means existing project is being expanded, and it has placed 100% of boiler, turbine, and generator equipment orders with BHEL and L&T. So those orders are secured. It has also obtained environmental approval for 38% of the under construction portfolio, and work is in progress for the balance of the proposed capacities. Now the key point is the for these power projects is the availability of coal. So it has received coal mine allocation of 14 million metric ton, which is expected to operationalize over the next few years. This should help it bridge potential demand supply risk on domestic coal. So now if you see here, the one in the blue are the existing capacities. The one in the green are greenfield projects which they are developing, and one along with blue, what is written in orange is the capacity which are being expanded. So if you see here, they have projects all over the country, and I'll show you separately also what is the logic behind these projects also. And present capacity is around 18 gigawatt. They are adding 23.7 gigawatts. So their targeted capacity is around 41.8 gigawatts. So they have projects all over, uh, and they are doing projects across the country also. So the capacity growth, which is around 18.2 gigawatt right now, should be doubling by FY32. So in next 5 years, 5 6 years, they are talking about doubling their capacity. Now, it's how they have created their assets. Either the assets are near pitheads where the coal mines are there, so that problem of coal is sorted out, or coastal. Now, these coastal ones are connected to their own ports. So what happens is that they can get imported coal very easily, and then few in hinterland is there which are well connected by rail and other means. So now if you see here, plant and mine locations. So in blue are their plants, then co-located with mines. Then there are ports. So Mundra, Mangalore, and Dhamra. So these three ports for imported coal they have kept for to look after this region, Mundra power plant, and the things which are there in this area. And then there is a port here, which they are developing now for their plant here. So they have good combination of mines, plants, and port connectivity uh, for getting the imported coal, and PPA counterparty states for APL. So these states in orange are their PPA states, uh, where they have done contracts with. Uh, so only power producer in India with in-house mine to plant logistics capability, they have entered into commercial mining. So they are handling approximately 74 million metric ton per annum of coal and fly ash. Uh, and they have 18,500 rake equivalent of fuel handled annually. So they are managing around 30 domestic coal rakes loading with around 65 rakes in circulation. So they are okay in terms of their logistics. Now, coming to the plants, so executed organic capacity is around 10.8 gigawatt. Inorganic growth, which they have done by acquiring plants, is around 7.2 gigawatt. So total present capacity is around 18.1 gigawatt. So they're organically they have executed four projects: Mundra, Tiroda, Maharashtra; Kawai, Rajasthan; and Goda, Jharkhand. And in Kawai, they are adding 3,200 megawatt of capacity in addition. Uh, they have turned around the plants by acquisition, integration, and turnaround. So that is additional capacity which they've got, inorganic generation capacity at various places all over the country, and at some places like Raipur, Raigad, Mahan, Madhya Pradesh, and Korba, Chhattisgarh. They are adding additional capacity for which they are working on that. I'll show you that also. So now this plants which they are adding 23.7 gigawatt. So if you see here, most of the land they have got approvals. Equipment they have ordered 100%. Environment clearance is 38%, which is in progress, and PPAs of roughly around 25% or is done. So that is sorted out. So it is under control as such. So their execution model is pretty good. They are able to get all the availability of land, water, project power, and other key enablers. Execution is good. Adani Infra and the ITD cementation part execute the projects. They have project supply chain assurances in terms of boiler, turbine, and generators. Availability risk, so they have done these PPS with Discom, so that is not a problem. FSA for coal is there, so that shortfall is taken care of. Fuel, they have agreement for fuel cost with adequate change in law protection. So they are able to pass through the fuel cost of the imported coal. So that problem is not there. They are developing four coal mines with 14 MTPA production capacity. So using Adani Logistics for logistics assurance. Because of PPAs, they have high visibility of cash flows. Credit profile is decent, and most of the projects are self-funded by uh, assessing the debt capital market. So now if you see here in terms of revenue, this is in millions. They will do around 55,000 crore of revenue this year, which is same as FY25, and then it will grow around 10% every year. But basically, issue is because they are developing capacity right now. Interest cost, if that was a concern, so interest cost is going to go up and significantly in FY28 because as more projects come into play, EPS would be generally in the same range around 30 or 30-31 for FY26 and 27, and 28 it will increase to 38. Now the point here is that the gross debt is increasing. So if you see here, gross debt is increasing and nearly becoming 70-80% now to around 80,000 crore in FY28, and you must compare the gross debt to EBITDA. So 30,000 crore EBITDA with 80,000 gross debt is manageable because the interest cost maybe around 7-8% of 80,000 crore would be easily manageable with higher EBITDA, which because of the visibility of revenues. So they are growing to, after this year, they're going to grow around 10-15%. EBITDA margins are improving. ROE, ROC are improving. Net debt to equity is not very high. It's manageable, and net debt to equity, EBITDA is also around 2.3, 2.1. So it's not much, manageable. Valuations are slightly on the higher side if you compare with the NTPC, but they've got good execution capability. Uh, the net debt to EBITDA actually has declined now. So it will rise to the peak of around 3.2 times EBITDA net debt, but then it will decline as the debt gets cleared. So this stock has been in this range and has declined significantly on negative news related to the group as such, but then has bounced back, and now it has been seeing a gradual rise to around 600, 660 levels, and then there was because of the stock split, etc. There was a big spike and the good news with this Adani group. So with good volumes, it went up. So uh, it's a good stock to hold somewhere closer to this 630, 620 range, but it will be always be vulnerable to some disruption because of things which are not related to the earnings. I finished. We'll take questions now.